right, thanks everybody for joining us. As you can see on the screens, we want to give a big thank you to our sponsors. We couldn't do everything that the chapters do between Utah, Colorado, and Wyoming without the sponsors, so we wanted to say thank you. As you can see on the screens, so cycling through all the sponsors. I won't go one by one. Sometimes we do that, but it is 12 o'clock. We'll go ahead and get started. Hello, my name is Doug Jennings. I get the privilege of being Region 3's RVP for CCIM. And with us today will be Casey, the Chief Economist for the CCIM Institute. He's going to share an in-depth look at many factors affecting the economic tides, what to look for on the horizon, and how to ride the wave of opportunities in our regions. Please feel free to ask questions throughout using the Q&A tab. I'll say that again, the questions and answer tab, use that. We'll be monitoring that. Everybody will be muted, so we will not hear the background noises and interruptions. But if you want to ask a question, use the Q&A tab. We'll answer as many questions as we can get through in the discussion. And if you are experiencing any technical difficulties, please use the chat feature, as you can get help through the chat. The presentation today will be recorded, and you will be sent the recording in hopes that you can use it down the road with others that didn't get to join, or if you want to send it out for marketing collateral information, it's yours to use after that. So this is a benefit of the Institute that's providing for the chapters, and we hope you get something out of it. I always enjoy Casey's time. And I know he has some local roots in Denver, so it's always fun to hear and talk with Casey. That being said, I'll go ahead and pass it on to Casey Conway.
All right, thanks, Doug. There's a little bit of a lag here, so call the slides up. There you go. You see them okay?
Yes, sir.
All right, appreciate it, Doug. Yeah, I've been out in Colorado a little bit this summer, unfortunately for end of life family stuff, but one little vacation. But monsoonal rains are keeping Colorado wet, at least in the mountains or where I was. So that's all good news for you. So it's really great to be with Region 3. I have a special fondness. I started my career a little south of there in Arizona. Love Colorado, Wyoming, Utah, incredible economy. I've actually I have to say, having grown up in Vail, my dad being a part of it, I actually am now starting to lean more favorably towards the Utah skiers, because you can get there in a short period of time. The I-70 is a disaster, but a great place, the mountain area. So we'll just we will get right in here and jump right in. So I modified the title here a little bit from surfing the economic shockwaves to snowboard surfing, because you guys do snowboarding more than you do the ocean stuff. And I put the Region 3 triangle there to match up with my old and my legacy golden triangle that I talk about a lot. So there's your snowboard, and we'll go in here. Here's my normal disclaimer. I won't spend much time. This is to protect the Institute, and your chapter, and your sponsors, and everybody that I'm involved with. So it's just me that gets sued today if I say something wrong, or Beverly will have to get our square out and negotiate a settlement. I do want to put one thing up on my bio here, to point that some of you may not have heard about, but at the beginning of this year, I was appointed to the Appraisal Foundation's Board of Trustee. So the Appraisal Foundation was the entity created by the long ago FIREA legislation from the S&L crisis to regulate appraisal industry. And there's a lot going on the valuation side that could completely turn upside down how we think about valuation, how we do appraisals. And so with our whole world, although we may not be appraisers or transaction people or brokers or property managers, you really need to dial into that this year. So I got a front row seat there, and it's like being at the hockey rink, and you're right on the corner where all the hockey players get shoved in the wall. I'll be having to pay a lot of close attention. And here's the two things I'd encourage you to start putting in your mind. There'll be a CCIM article on this coming out this fall. The Institute's been on top of this. So two terms, PAVE and PAREA. PAVE is the property appraisal and valuation equity. That's bringing the DEI into the appraisal world. And the other one is PAREA, which is the practical applications of real estate appraisal. What you need to know about it, it rhymes with FIREA to PAREA. and USPAP could be retired. We could end up with USPAP, Uniform Standards of Professional Appraisal Practices, USPAP Light or USPAP Good Night. And so it could be very, very, very important to understand what happens here. USPAP was supposed to be renewed every 2 years. It wasn't renewed this past year. It's extended to 2023. It's probably going to be extended all the way to 2024 until Korea is actually put out for public comment and implemented later this year. Here's the piece to add on your radar. This is why you want to pay attention. Kids back to school, everything else. The fall edition of the Sire magazine. We've just completed getting this all drafted and edited, and CCIM Institute's on top of it. We look at 3 elements that you should be paying attention to on valuation. One is more of our real estate has a going concern element. That's important for property tax assessments, not just hotels and restaurants. It's self-storage, it's manufactured housing, it's all of those items. The second thing is ESG. We now have ESG scoring going all the way down to the property level, and it will become as impactful as selecting a cap rate. And IREM is the one that has it right, and the proxy advisors like Glass Lewis and ISS have it wrong. And so you really want to start to understand, you'll need to have in your brokerage packages, you'll need to understand whose ESG score is applying to your property, how it impacts value. And then the third one is this PREA implication. So just wanted to get you a heads up. You guys are the first region to get this intel. So pivoting from that, the #1 economic issue for you guys in your region, and then on down into Nevada and Arizona, is not the Fed, it's not inflation, it's not interest rates, it's water. And if you were paying attention this week, you noticed that the federal courts ruled, as they were threatening to, on how much water could be allocated out of the Colorado River Basin down into Arizona, Nevada, and the 7 states that survive off of the Colorado River water flows. And it's not just water, but it's hydroelectric generation. And the conclusion was, right now today, they had been pulling out 12.4 million acre feet of water out of the Colorado River Basin. And the courts just said, Arizona, Nevada, all of you downstream, you get it cut by 1/3. It contracts to 8 million acre feet. And what does that mean for the downstream states like Nevada and Arizona? What does it mean for hydroelectric generation and electricity? What does it mean for economic development? Somebody wants to put in a new bottling plant or something that has heavy water usage. It may suddenly have just been put on the back burner. Residential development. There was a big announcement in Orion today on the on new green subdivisions and how they're going to have to be redone, and a new one that has almost 0 exterior water retention and underground water storage and cistern. So for your region, everybody in the Colorado Basin region, the 7 states, Arizona, California, Colorado, Mexico, Nevada, Utah, and Wyoming, you are hugely impacted by water. And it will dictate whether you have housing growth, whether you have population growth, whether you have industrial development. All of these things are critically important and are going to have an impact, and nobody is connecting those dots yet. And so I'm encouraging you guys in the Institute, again, to be the leadership role here. There are a lot of hard choices. And even if they could get agreement on redirecting the Mississippi River to fill everything up in the West, it would take 30 years. And if you think that in the southeast region, they're going to easily let you take their water away from them, even though it's always flooding, you're crazy. Maybe China could get it done in 3 years, but there's no way with the environmental studies and reports and what they use it for in agricultural. So there's no easy answers here, and it's going to get very interesting. This is your #1 economic issue, and we all need to, in your region, start connecting the dots. What does this mean economically? And I'll probably be working on some papers on that through Red Shoe Economics. So here's an example of a deal. This was just recently announced. Those of you in Denver know that the Pepsi, they finalized the deal to build a plant near the Denver International Airport. They're going to need a lot of water. And how is this going to work? Where's it going to go? Do these type facilities suddenly get put on hold, even though they've been announced just back in July here? And do they move to where there readily is water, and then they put the finished product on rail or trucking? Because the transportation costs, honestly, could end up being cheaper than the cost of trying to get the water, even if you could get it. So when you look at these type of big announcements, this was an important one for Denver. Does it sustain? Does it get built, given what was ruled by the federal courts on Tuesday of this week for everybody in sharing the Colorado River water? So this, when we were doing this, was a good announcement. Now we got to watch and see what the impact of the water stuff is. Arizona, which is not in your region, but it's important to realize what they've been doing. I started my career in 1985, 86 down in the Phoenix area, and we had a water problem then, and 35 years later, they still hadn't fixed it. But Arizona is acting on the water risk to its economy. In July, it passed a piece of legislation, Senate Bill 1740, that would allow it to basically figure out how to go attain other water resources, look at groundwater more, look at retaining from the monsoonal flows. They're doing more retention. Every new development has to have underground tanks where they store the runoff water. And Phoenix today has underground in the city the equivalent of 1 year of water. So even if the courts had ruled zero water, like the Seinfeld episode, no water for you, Arizona, even if they had ruled zero, the Metro Phoenix area has the equivalent of underground. They've been working on 1 year of water storage. So these are the kind of things that we're going to see happening. And as they do, we need to connect the dots economically. So this is a good piece of news just south of your region. I know a lot of you probably have clients that spill over. You can't just look at your region in isolation. You got to look north to what's in, north and into your west and into Arizona and Nevada. I mentioned this Mississippi River diversion for water. This has been a big idea that's been floating out there the last 30 to 90 days. This is a solution to all of our water problems in the West, and it's just not gonna happen. What you have to understand is how this background came. When you look at the old river control structure where the Mississippi River goes way back decades. It feeds the largest bottom land. Second, I gotta move. Something's popping up here. Apologize for that. The largest bottomland hardwood forests and wetlands in the U.S. is actually what the Mississippi River feeds in terms of water is bigger than the Okefenokee Swamp down in Florida. And it's also very critical to all of our shipping and supply chain in the inland rivers and into the ports like down at the Port of Mobile and into the Gulf region. So any of you that are thinking this is going to be a slam dunk easy issue, it may seem intuitive, but it is logistically a nightmare to try to figure out. So don't think the Mississippi River is your solution to the water problems. All right, so that's your big issue to put on the radar, be thinking about it, be anticipating that a lot of industry, I think of Coors Beer, in Golden, Colorado, and the water there, and how much of that can be retained and how much has to go downstate with a 1/3 restriction. A lot of economic impact there in the Western states. So let's pivot and talk about GDP. So there's all this debate whether we're in a recession. So at the end of last year, I warned everybody that we would have negative GDP in 2022 here. It would be negative in the first quarter, be negative in the second quarter, and guess what? It's going to be negative in the third quarter and negative in the fourth quarter. The unofficial definition of a recession is 2 consecutive quarters of GDP growth. And so we've had those 2 consecutive quarters, as I predicted. Sorry about that. Thought this was off. All right, there we go. So we've had the 2 consecutive quarters, and we need to understand why. The real definition of the recession will be determined by the NBER, the National Bureau of Economic Research. And by the time we're in recovery in 2024, 2025, they'll tell us that we're in a recession right now. So no good waiting for the NBER. And I'll give you one other indicator that's pretty predictive. Look at the percentage of stocks that are hitting new 52-week highs versus 52-week lows. And we have now had 40 consecutive weeks where we've had each week more lows, 52-week lows set in the stock market than we have 52-week highs. That's another real good indicator looking at the number of highs and lows from an industry standpoint. Look at what's being told to us by the earnings reports that we've been getting. We've been getting even the retail this week. People are buying more because they're having to pay more. They're not buying more goods or more widgets, they're paying more for those. So retail sales look a little bit buoyed by that. So you can see the latest GDP numbers. And let's explore why the GDP decreased. So a couple of things. Look at it by state. 46 of our 50 states, and look at your region, look at Wyoming, you're almost 10% negative state GDP in the first quarter of this year. They don't have the second quarter state level data out yet. Colorado, you're -10. Utah, can you believe it or not, you're -2. 46 of the 50 states are negative GDP at a state level. The only 4 that are above it, that are in there are all in places you'd scratch your head. New Hampshire, Vermont, Massachusetts, Michigan. So it's kind of weird. So if 46 of 50 states are negative in the GDP level, the GDP level at the national level is not going to get revised positive. The second thing that is, so this is really important, keep this in mind, And if you look at the states that have the most negative GDP, there's one common element. It's water. It's either drought in the plain states or it's the water issues in the West. And so we're already beginning to see this water issue play out as an economic impact in terms of state level GDP. So that's why for your region, I'm really bringing this in. We've not shared this anywhere else with anybody yet. This is unique and new to you, that I want the CCIM Institute in your region to be able to lead on this issue and start connecting these dots. So the other thing that is important in this GDP number is to understand that why did GDP go flat? So we just got the second quarter GDP numbers and it says, see, inflation's peaked, it's all going down. And if you dissect it or you follow any of my posts on LinkedIn, you know I gave you an explanation right away as that data released in the PPI data. The answer is energy. So when you start to release the strategic petroleum reserves and bring energy prices down, gasoline prices down, and states suspend gas taxes, you artificially bring the price of a gallon of gasoline down almost $1 a gallon. So if energy drops that much, it masks what's going on in everything else. Food prices over 10%, labor costs are up over 10%. Used car prices are still rising on this stuff. So all the other elements in the index that comprise GDP are rising, and the energy is such a big component, it masked that and made it look zero. Here's what you need to put on your calendar. So the urgency to get deals done, get your clients' attention, and take advantage of the 10-year treasury below 3% because it's not staying there, is the following. The drawdown from the Strategic Petroleum Reserve will likely end in mid to late October because under the legislation, we'll have had the maximum drawdown in the reserve that can happen. So right before the November elections, with all of the inflation kind of muted and energy down, guess what happens in November and December? All that goes away. And we go right back to high energy prices on top of everything else. Get ready for 11 to 14 to 15% inflation when we get the November and December numbers in December and January. So, and the Fed's going to come back from Jackson Hole. So your Wyoming CCIMs go up there and eavesdrop in Jackson Hole. Well, there won't be a meeting this month. They'll come back in September. And the big debate is, what are they going to do? Are they going to continue the 75 basis point hikes in the last two? Do they slow it maybe a little bit to 50? Do they go 100? If we keep getting the jobs reports like we just had for in August for July, and we keep getting everything else as an inflation reading on food and everything beyond energy is running double digits, the Fed understands what's happening with the SPR reserve. They are not going to take their foot off the accelerator and look like, you know, they placated energy and then have to come back in November and December. My prediction is the Fed will keep on the 75 basis point hike in September. And then when we get out of the strategic petroleum reserves and the states coming off of their gas tax relief, the Fed knows there's a bigger inflation story coming. So I don't think there's any abatement here. And so September, that September FOMC meeting really honestly may be, you know, everyone's the most important, right? But it will truly be very important to see what the Fed does on inflation. So this is my legacy inflation slide that y'all know, my risk of inflation, why I've been predicting since the end of last year that we were going back to a 1970s style inflation cycle here. And so the blue line is the inflation rate, and you can see how high it got there in 73 to 81 timeframe. And look at how it dipped around. Inflation didn't just stay on a solid trajectory from 73 to 81. It bounced around. So this little bit of a relief that we've got, there were things that happened. The Arab oil embargo went off. We transitioned from Ford to Carter. There were different things that happened. And it was really an 8 to 10 year problem before it got tamed by Ronald Reagan, really 82, 83. And all those tools that Reagan had, where rates were high and you could bring them low, you could do tax cuts, you know, we could take on a little bit of deficit spending. None of those tools exist today. We are at record levels, $30 trillion in debt. We've had more deficit spending and debt accumulation in the last decade than the entire history of our country. So these new tricks, these new tools, we don't have rates high that we can bring them lower. We've got to bring them higher. None of those tools exist for the Fed going forward here. So that first point, you know, inflation didn't increase in a straight line. The SPR, Petroleum Strategic Reserves release I've talked about, and then look at the spread between the 10-year and 2-year curve. So inversions don't 100% of the time reflect a recession, but they do almost all but 1 or 2 of the times. The 10-year, 2-year difference right now is over 40 basis points. It's the biggest spread that we've had right now, which means if short-term rates are high, that means the market believes interest rates have to go higher and inflation is still with us. If the 10-year is below, they think, well, maybe things will get better. We're not going to be that way forever. So you have a market saying right now, we see more inflation. We see the Fed continuing to raise interest rates, but we're hopeful that 2-3 years out, 10 years out, it's not a problem. And so really follow that spread in the yield inversion. It's a pretty reliable indicator of recession. I'm in the camp, we're already in it. We're going to have 2 more quarters of negative GDP. When you get the market digesting that it's 3 consecutive quarters, 4 consecutive quarters of negative GDP, you'll really begin to have the market accept. So this is kind of my legacy slide that I'll be having for a long time here. I'll tell you this, the index on inflation that I rely on the most and have kind of brought back to life here is the St. Louis Fed's flexible CPI. So this isn't the one you do in calisthenics in the morning or doing Zumba. This is the one where the St. Louis Fed has been doing this all the way back into the 70s. And they strip out of CPI those things that reprice about every 90 days, including rent and shelter. Rent and shelter reprices every quarter. It's not just energy, it's not just food. And what they do is they look at that in March of 1980, it hit its all-time high of 23.23%. We broke that in March of this year at over 25%. And right now we're running, it's came back to about 16.5%. You can see on the right with the yellow arrow. All of that reduction is all because of energy prices coming down from the SBR reserve release and the suspension of state gas taxes. Those both go away in the month of October, and we go right back to this 23, 24, 25%. And that's the real inflation rate that households are experiencing. That's why Americans and the consumer confidence and all these things have been hit so hard. Small business optimism. Look at the housing industry, the home builder optimism index by the NFIB. All of them are hitting levels within a year that it took years to hit, even in the Great Recession, and years to hit in the 1970s. So this is my favorite real inflation indicator. Jim Bullard is one of my favorite St. Louis, my favorite Fed presidents. I've known him for a long time. He's been right on inflation for over 18 months, telling the Fed to get with it, and they wouldn't listen to him. So with what's happening next week in Jackson Hole, if they get on Bloomberg or CNBC an interview with Jim Bullard, go ahead and take 30 minutes off and listen to that interview. All right. You also know that one of my other favorite indicators, I'm an industry economist, not an academic, and that I look at is ENR, the construction cost index. So here's the latest number. So you saw, and you've been tracking, I've been telling you since for a while here, that you met Pittsburgh last fall, that we saw in the spring of a year ago that the construction and building cost indices were rising. So the construction one is materials, the building cost is materials plus labor. We were, in the 4, 5, 6% range last spring a year ago. Though that went up in the fall to 14 plus percent on the building cost index, 8% on the materials. Then we really hit high in the spring of this year, April, May. We were at over 16%. We hit up to 18% on the building cost index. And right now for July, the latest data, it cooled to 13.5 to 7.6. 2 things have caused this to cool. One is the energy and transportation costs have come down, but more importantly, the housing industry, home building industry is pulling way back. They are truly in a recession. You look at public builders like D.R. Horton that built almost exclusively spec homes. They've pulled way back. They've reduced their prices. So the competition for copper and concrete and building materials has cooled from the housing industry, causing some relief or enabling some relief in the commercial industry. They also have a city index that they track, and important ones to look at here. There's not one for Phoenix, but obviously you've got Denver and Dallas. So Denver in your region 3, and those are still quite elevated. Denver's over 16% year-over-year construction cost increases, and Dallas over 22%. The only entity that's higher is if you look at New Orleans, which is still working with rebuilding costs from the hurricanes. So Denver, the cost of materials, and with this water issue, it's going to get even harder because in a lot of the building ordinances, it requires it on the construction sites when you're doing it that you got to keep the site wet, keep from the dust going and irritating nearby, property owners and residents and whatnot. What is the cost of just even that one item if they can get water to keep the sites wet and not all the dust blowing around? So this one we've had relief, but again, it's a head fake. And I think it continues, and we'll see it increase later in the year. We could see it stay below 15% because of the home building industry being in recession. And understand that comment, the home building industry in recession, not your home value. Home values are the home price appreciation is gonna cool, but your house is safe. If we're still creating households and we can't provide more inventory, the pressures are gonna remain on housing. Your single family home will continue to rise in value, maybe not at the double digit numbers, but good solid single digit. And rent numbers, multifamily is going to be very strong. So if you're doing multifamily, there's no abatement coming in rent relief here, because job creation is strong, population and workforce migration into your region. And then if you can't buy a home, you've got to rent. So I'm optimistic if you're on the multifamily side. Okay, again, why the CPI flat? This was my post that I did on the, breaking down the different indices that comprise a CPI. You can see what happened on the energy in the middle there. But if you look down, closer to the bottom, you can see what was happening in the food index in this thing here. The overall inflation index is still over 8.5% year over year. So 1 month in July does not make a trend. And if you factor in what's going to happen with the skewing of the SPR and the gas tax suspension, you begin to understand this inflation thing right now. It's a head fake for about 3 months. And what does that mean for you and your clients right now? It means a 10-year treasury staying below 3%. It means the ability to leverage and put debt in place, provided one thing, that the banks still lend. But what's happening to the banks right now, I just spoke to a conference of all state bank regulators, is the bank regulators are telling the banks to cool it on construction lending. The banks had not been paying attention to the cost overruns that were occurring in their construction loans. The bank regulators are very worried about that. They're going to impose, coming in the fall here in the next stress test, that banks uniformly, whether their construction loans are performing or not, they think the risk is so high that they won't and be hit, that they're going to impose that they have to downgrade these loans. That means hold more capital. So the tool that the Fed uses to make the banks look like the bad guy in these situations is called IOER, interest on excess reserves. And right now the Fed pays the banks very, very little, less than 0.5% on all of the reserves that they're holding to meet their capital requirements. If the Fed further wants to constrain the economy without going to 100 basis point rate increases, they simply tell the banks, we're now going to pay you 2.5%, 3%, 4% on those reserves you're holding, but don't lend. So hold the reserves. We'll pay you a risk-free from the federal government, just don't do construction lending. And we're already seeing major banks do this here in the Southeast. Regions Bank, a major regional bank lender, already said in their earnings, commercial real estate shut down. And many of the developers, merchant developers that I work with and communicate with are all expressing that they're seeing this happen. In fact, one of the clients, very major developer, had JLL out there that was working with 56 different lenders to provide capital and renew their credit facility, and all but 3 bailed, all in the last 30 days. Said no more construction lending, no more institutional equity money. They're all kind of panicking and pulling back in until they understand. So the best thing you can do on your clients and your own portfolios is you really need to pay attention to the capital piece. So when you and I most came along in our careers, we were told real estate was all about location, location, location. Wrong. It's about location, timing, and capital. And so if you have good location, but the timing is bad right now, and you don't have the capital to execute, it's a bad real estate deal. So put the LTC up there to replace LLL right now. So forget the L on Laverne and Shirley. Now I just dated myself again, out of Milwaukee, but it's location, timing, and capital. And the best thing you can do for your clients right now is help them with the capital piece. All right. So when the Fed started raising hikes, how often do they do it? What does it look like? So I put this together earlier to look at what the Fed rate hike looks like over the last 10 years and the last 20 years. And when the Fed moves on interest rate hikes, they've never done less than 8. So we're about 3 or 4 into, not even halfway into the rate hike cycle that what they normally do. You can see what happened in the 10-year. If you go back and you look at, the 2014 timeframe, and when we had the 3% taper tantrum, they went from basically about 1/4 to 2.4% in less than a 2-year period. If you go back 20 years, look at what happened between 2004 and 6. So this is the 2-year period before the great housing recession. So everything was going gangbusters. I was at the Fed during this time, and the Fed was trying to deal with subprime mortgages and the housing and pinprick that, and they went from 1% to 5.25% in basically 2 summers. So if you don't think the Fed will move, they really will. And I put in the middle there what's happened. Remember, this is the Fed that a little over a year ago said no inflation. Then they said, we'll go back to January 2021, no inflation. And they said it was transitory. And they said it's transitory longer. And they said, forget we ever said transitory. And then we got to January and they said, oh my God, we do have inflation, but let's just not spook the bond market. Let's say we see, evil, hear no evil, speak no evil about inflation. They had no meeting in February. So when they got to March, they were like, we can't hide anymore. So they did a token quarter point increase. Then they went, had no meeting in April. They saw it was even worse. They had to go to 50. Then they got to June and July and said, oh my God, this is really bad. For 8, 9, 10%. They had to go to 75 basis points. Do you really think that they don't understand the SPR and the energy reduction masking and that they're not coming back from Jackson Hole? September will have more rate increases. The debate's going to be, is it 50, 75, or 100? I think it's at least 75. And if more people like Jim Bullard have their way, or Esther George out of Kansas City that covers your region, your district, that I think there's a very high probability, over 30 to 45%, that they'll do a full 1% increase in September. If they don't do it in September, they're going to do it in October. The inflation number is not going to abate. All right. If you don't think that's scary enough, look at the history. Go back to 1973, 74, 79, and look at, in the red boxes, how much they've moved the overnight Fed funds rate. So in 73, between May and August, they went from 7.5 to 11%. It's mind-boggling. But when they get behind and get panicky, they really do it. Paul Volcker would wake up in the middle of the night in between meetings and say, I just got to have another rate hike. I didn't get enough before I went to sleep. Look at 74 between February and July. They went from 9 to 13%. And you remember, so it went from 11 back down to 9, then it goes back up to 13. It's not real even. They're trying to figure out data dependence. And then in 79, look at between September and October from 11.5 to 15.5%, and where things really ended up. We know by 81, we ended up with a 21% prime interest rate. So the Fed's behind, they're panicked, they're not taking the foot off the accelerator. So the best thing we can do is help our clients recognize those windows of opportunity, like right now, when the 10 years below 3, before the next interest rate hike, and before the market figures out the SPR release gimmick. All right, yield curve inversion, I mentioned that earlier. So here we look at the top, here's the total spread. We're at 41 basis points. You can see it's the most that we've had all this year in terms of inversion. We had a little bit of one in April where we went, 0.9%. We're at 41 basis points. If you look at the two on the bottom, you can look at where the 2-year treasury is, 3.25 when I put this together last week. And then you look at the 10-year, 2.85. It makes no sense. But it only makes sense if you understand what the market's thinking is, which is near term, we have inflation. Near term, we have the Fed raising rates. But long term, we're hoping that that's not going to be sustained and we can live with something in the 3% or less range. I think that sentiment, that market view changes very dramatically here in the second half of the year, especially after the Fed's September meeting. So keep this one on your radar. Keep this in communication with your clients. This is why, if you have any clients that are looking at something that's coming up for refinancing the end of this year or next year, I would look at the prepayment math calculation and I would be refinancing. I would be encouraging them to basically pull the trigger and put something away right now. Do not sit on the fence. All right, consumer confidence. This is what happens as all this is unfolding. The consumer is actually pretty smart and ahead of us. And so if you look on the bottom left there, the University of Michigan consumer confidence. So it rebounded a little bit here in August, again, because of the energy relief. But look at what was happening up through June. In June of 1980, the consumer confidence, University of Michigan, hit its bottom at 58.7. We broke that all-time record in June of this year at 50. And so if we hadn't had the energy relief, this thing could have even been below 50. And so you can look at the consumer sentiment there. The consumer is really feeling it. If you think about that flexible CPI and what's really happening is we feel like a 16 to 22, 23% inflation rate. That's the real household inflation rate. All right, the NFIB Small Business Index, here it is. It really peaked down there at the bottom in June. It's peaked up here in July and improved a little bit. Again, it's all this energy head fake right now. It is so important that we understand this, that we're able to explain this to our clients and recognize you as CCIM Institute members and experts in commercial real estate You have the ability to understand what's going on over the next 90 days. Help your clients understand this window of opportunity before it closes, really, I think, by late October, early November. The misery index. I don't know if some of you are old as me can remember the misery index. But basically, the old misery index was basically you take the unemployment rate, inflation rate, stack them up, and you've got that. It peaked at 12.7% in 1976. You can see in the chart here in the middle, this is the one that also looks at the misery index in UK and Europe. So their inflation plus unemployment, all of them have been trending upward. The new misery index, so this was created by Forbes, and they've updated it. So in the 70s, most American households did not own stock. Today, over half of American households own stock, whether it's in their 401k or just individually held on a retail level. And so what they've done is they've added into the equation of unemployment and inflation, unemployment and CPI inflation, but they've added in, look at what's the change has been in the S&P 500 and GDP. And so since GDP is a negative, you add a negative, you get a positive. And look at the S&P 500, it's down negative. So when you put those two together, the new misery index is more than double what the old one was in 1970. It's over 29%. So this is another one of those very realistic people industry impact that brings in consumer confidence, business confidence, inflation, CPI, what's happening in the stock market. And so if you haven't reacquainted yourself with the misery index, particularly the new misery index, you can Google Forbes on there. They were the creator of this on there. Here's what the old one looked like during Ford and Carter with just unemployment and inflation, CPI or PPI. I tend to use the PPI because that's what's coming to the CPI. And you can see what happened now. It went up and Nixon came down, then it went really high during Ford, went down when Carter took over, and then it went really bad towards the end of this thing. So misery index, pay attention to it. Inflation and commercial real estate value. So this is what we all really want to know is kind of what's happening to commercial real estate. So there was a piece posted today by a good friend of mine, Jim Costello, of the former Real Capital Analytics, where he said, inflation is terrible for commercial real estate. And he used Brazil as an example. Commercial real estate is the one asset class that does well during an inflation cycle, destroys bond investments. It hits stock equity because if you discount the future earnings at a higher rate, we all know our discounted cash flow, discounting at a higher rate means the value of those future earnings is less. Commercial real estate offers two things, and we need to remember the principle of substitution. In a high inflation environment, the cost of building a new asset costs more. And so people look for substitutes, and they bring the prices of substitutes, whether it's an adaptive reuse or settling into something that's older and can meet your needs. Those assets all go up in value and we don't build new. So I strongly disagree, and we'll be writing a piece over the weekend. While I love Jim Costello and respect him tremendously, he's 100% wrong that inflation is bad for commercial real estate. Look at what's happened with REITs. Look what's even happened during the Great Recession. Go look back in the 70s. If you entered the 70s with commercial real estate and endured that inflation cycle, you came out of it in the 1980s very, very wealthy and real estate assets doing well. But we're seeing a couple of things happen. I use Green Street here as an example, but you can also look at Real Capital Analytics and CoStar, which have CPPIs, commercial property indices. And what you can see here, I've got circled at the top left there, that's the long-term chart on the commercial property price index for Green Street. And you can see, except for manufactured housing and industrial and storage, that for the most part, all have really dropped down in their rate of growth. Every single asset class is turning down. The rate of property price increase is slowing. And so if the rate of that increase is slowing, what's causing it? Is it cap rate are rising? Not really yet. What's happening is expenses are growing faster than rent growth. And so expenses right now are growing 2.5 to 3.5 times the rate of rent growth. So if you look at an apartment, still getting 4%, 5% rent growth on average. If you look at Rent Cafe, that's kind of what they're reporting. And you look at expenses in those apartment communities running 12, 15, 20%. Labor's more, utilities are more, janitorial's more. Every single aspect of running in a property is in the double-digit numbers. So if that expense side, which the multifamily, you can look at 35 to 45% expense ratio. If those are running 3 times what the rent growth number is, your NOI is going to contract. And even if the cap rate doesn't, the value has to correct. And that's what we need to be paying attention to. Industrial will hold up very well, 42%. The apartments aren't going to crash and burn. We're only delivering 450,000 units this year. While that seems like a big number and the highest since 1987, we normally would build 350 to 400,000. So you're talking about 50,000 extra units across over 150 MSAs. That's 300 units a city. That's one apartment project is not going to tank the vacancy or the rent absorption number. So everybody is panicking over multifamily. The any concern should be the urban markets, where we've seen the population and the workforce move to the suburbs or move to secondary markets. They've moved out of New York, they've moved out of San Francisco and Seattle. You've seen the growth in Denver, you've seen the growth in Utah. Wyoming, you've seen some of it in your markets. You've been skewed by what happened on the energy side. So pay attention to the CPPI index and know that we're going to have some value correction here. You can't have rents or expenses growing 3 times rents. Even if cap rates stay the same, there's some value correction coming. And that's what this chart is really showing here. That's what I want you to take away. The next one, we talk about office a lot. And so my favorite index that I follow here in data set is the Castle system. They invented the key card technology that we all use to go in and out of buildings. And they've been tracking this for a long time, and we have not been able to get above 44% on a national level. And when you break it down at a city level, what we find is that the cities where we've seen the most back to work, it's all in Texas. It's Dallas, it's Austin, it's Houston. You can see those numbers all above 50%, Austin over 57%, Dallas over 50%, Houston over 54, almost 55%. Everybody else, it's a lot more tame to that. Denver, you're running in that 40 to 45%. And you're actually fortunate to have that because everybody would rather be remote in the mountains. We're not dealing with all of that Denver traffic or I-70 traffic. Utah, you know that, again, you're sitting in a bowl and you can get into the office in 30 minutes to an hour from the mountains or the ski areas or Alta or whatever. We can't do that in Denver. If you're coming from the Western Slope and you want to get into Denver, it can be a half to a full day to come down I-70 that's only maybe 100 miles. So we are not going back to work. It's a different model. Companies at most are saying you got to come back 2 or 3 days a week. Workforce before COVID was fighting this issue because of affordability. And what we're seeing play out today in this Castle system data is the workforce has finally been able to demonstrate to the employers, we don't need to be in the office. And the employers have been able to say, we need to cut costs. So we can sublet office space or not have as much or put space in cheaper pockets in the suburbs or secondary markets. We're going to do it. And as much as tech companies out of California and Washington threaten to reduce their salaries for cost of living, they have been unable to do that because they can't get the workforce. So whatever you were making in Seattle and San Francisco, you can be in Salt Lake, you can be in Denver, you can be in Cheyenne, Wyoming, and you can still have that salary and have a whole lot more affordability. So I am still quite bearish on urban CBD office space, but I'm very bullish on the suburban and secondary market where we're seeing 12 to 15% growth in absorption, in rents, and values. So look at the suburbs, look at the secondary markets. You're not New York, you're not San Francisco, you're not Seattle, even Atlanta, we're seeing problems. All right, but here's the other piece that's pretty interesting. Some of you deal with retail and other properties. So back to the Keystone, Castle system has gone back, and they've also started adding other things. They're tracking what's happening with things like NBA games, TSA checkpoints, like I talked to you about at the beginning of COVID, restaurants and dining out. And what we're seeing at the top there is when you look at the social and the leisure activities, going to restaurants, going out, using retail, we're back within 5 or 10% of where we were before COVID. It's only in the office you see down there at the 43% number. So this is great. I would use this if you're looking at retail negotiations and rents and what to do. If you're over in the Western Slope, if you're in Salt Lake, you got those areas, retail, dining out, restaurants, leisure, they're all almost back to where we were before COVID. And they track all of this. This isn't a sample survey. This is actual tracking that's going on. All right, housing. We need to talk about housing because everybody's panicking that housing's in a recession, and we need to distinguish housing from home building. Home building is in complete recession. Everybody's pulling back. They can't get the cost of work. They can't get the land. They can't build spec inventory anymore. So the home building industry is panicking and pulling way back. But home prices are still doing fine. We don't have the inventory. We're still creating households. Here's what's happened. It's not an inventory problem. It's an affordability problem. So look at these 3 or 4 charts here. So look at the average 30-year mortgage and what's happened really in a very short period of time. We've gone from a 3.5% 30-year mortgage to 5.5%. We're back above 5, approaching that 5.5% number this week after going back below 5. Look at the median sales price of a home. In a short period, 2-year period of time, we went from an average of 300 to over 430,000. You can't have a 50% increase in home prices and not expect to have an impact. And then look at the bottom one there. When look at the average mortgage payment that went from 1,500 to 2,500 a month. You can't have almost a doubling in the mortgage payment and not have an impact in housing. It's all about affordability. So if I can mitigate those 3 charts by moving to a secondary city, to moving to the suburbs, to moving where there's affordability, guess what? I've just solved my housing problem. And that's what I've been trying to tell you since, years here, is that's why I follow at the beginning of the year. What do the moving companies tell us, whether it's U-Haul or United Van Lines or any of the others? Look at what they're telling us. And they're telling us the workforce has been moving away from lack of affordability to affordability. And now with COVID, we see this play out. So this is the housing story. It's affordability, not inventory. All right. Look at who's experiencing the most housing shortages. So look at the Wyoming, Utah, Colorado range. You can see the numbers there. Who's got a deficit as a portion of their state housing stock. So Wyoming, you've got room to go. But look at, Utah and Colorado, a 2.5 to over 5 times what you need in terms of shortages. It's quite severe. And if you go into the plain states, you don't see it. If you go even south into Arizona or into Nevada, you don't see it quite as severe. So it's because you guys create so many jobs. Utah, as you know, in Salt Lake City, in Utah, you were the top one in all the job creation and the economic growth over the last year. Even if you look down in the South, you look at Georgia, you look at Tennessee, you look at Florida, they're nowhere near the numbers that you guys have had in terms of the deficit in Colorado and Utah. So that's an important one. Your supply deficit, Colorado over 5%, in Utah over 2.5%. And so I call this one DYMI. Don't you miss it? So this is CCIM Tech, the CREPI. So as you know, if you were in Pittsburgh, the CCIM Tech team spent a fair amount of time talking about all the new tools, and we introduced the CREPI thing. And we'll be coming up to release the second quarter data number here. But if you look on the far right of this chart, you can see where the CREPI index, which is based on 10 data components, a lot of what I've talked about: consumer confidence, small business optimism, yield curve, the JOLTS data, the NFIB, the S&P 500, Green Street. These 10 metrics, the line there shows what would have happened to CREPI if we went back in time. And the blue boxes represent recessions and recoveries. And what you can see is we correlated back testing this CREPI very, very accurately to prior recessions and recoveries. And we've seen this decline because these data points are somewhat backward looking. It's going to be lagged. My forecast is that we've gone from the 103 to 95. We will get down into the 85 to 90 range here, probably by the time we get to the fourth quarter to the first quarter release next year. So this is a real thing you can send out quarterly to your clients to stay in touch and show them how on top of it the CCIM Institute is on another metric here, not just water in your region, but the CREPI index. This is a really good tool that I compliment our CCIM Tech team. I write the narrative for this. I work with Mark and Stan and Carol on this, and we worked on picking these metrics. A great tool that you have that CCIM Institute and Site to Do Business provides you. The link there, the site2dobusiness.com, the CREPI is free. So you can send this link. They don't have to subscribe to STBDB or be a CCIM Institute member. So you can share this with your clients. All right. L&T risk to monitor. So we're going to talk about a few things that we should monitor here. I've been talking a little bit. Some of you have heard me at different venues about Amazon, what's going on with Amazon. So in the first quarter, Amazon revealed it was losing a lot of money. And Amazon Web Services said to Amazon e-commerce, knock it off. We're not going to subsidize you anymore. You need to get back to a path of profitability. You shouldn't be owning Rivian as an EV car company that is the last one in line to get lithium and may not even be able to build its new plant in Georgia here, given some issues that are developing. They told them, quit trying to take on FedEx and become the global air cargo. They said, focus on your industrial. And when they started to focus on it, they found they had overbuilt anywhere from 20 to 50 million square feet. And so Amazon is out there trying to sublet it. They leaked here in the Wall Street Journal, it was about 10 million square feet. My being in touch with the big brokerages like, Colliers and JLL and CBRE and add up what each of them are doing in sublet or offering for sale, it's more like 50 million square feet. So this all has to play out. Amazon has to get right size. That's going to have a little bit of a disruptive impact, not a long-term one. It's probably a 6-month one. And it's mainly in big markets like Dallas and Atlanta, where they really went crazy. So we have a client relationship with a company called Comstack. I've been with them for years. We have an upcoming webinar that'll be open to the public. And we asked them to pull the data. As you know, Comstack is kind of like the lease comp of CoStar. So they actually get the leases. This isn't survey or speculative, and it's really accurate stuff that they have the transaction people and the appraisal people putting in, and they validate it. And what they found is that Amazon's lease rate, the average starting rate in the market versus Amazon has a basis that's about 25% below the market. So if Amazon wants to sublet or get rid of 50 million square feet, guess what? They can still be profitable and undercut everybody by 25%. So until this plays out, this right sizing of Amazon, I think you're going to see development slow on big e-commerce buildings. You're going to see companies that couldn't get a building built or get the numbers to work, whether it's a Home Depot or a big box retailer, they can slip into a great Amazon facility and at 25% less than replacement cost new. That principal substitution comes back to work. So this is very enlightening data by Comstack that's very, very real and very validated. The other thing that's happening is that old friend of ours, or not friend of ours, or frenemy, NIMBY, not in my backyard. In California, particularly Southern California, there's an anti-warehouse movement. No more warehouses. They're tired of the industrial in the Inland Empire overtaking neighborhoods. And they actually have a bill that's come out of a committee that would ban any more warehouse development in Southern California and maybe even statewide. And so when you put that together with the port problems, the labor negotiations right now, you are going to see a huge disruption, more of this migration of our supply chain moving from being entirely West Coast concentric to moving inland. So that benefits Dallas, Denver. It benefits Salt Lake. It could even benefit Wyoming. You've got great rail, you've got great interstate connectivity. You just have not had the same amount that, say, Denver and Salt Lake have had, or even down into Phoenix. So this is a story that benefits your region as we have more of this anti-warehouse movement. And you need to pay attention to it in your geography. Denver, you're seeing all kinds of NIMBYism. They don't want a lot of things. The people that got there from California don't want anything more. They want the rest of Colorado in the mountains and no one else to come visit and have them. And guess what, Salt Lake? That's coming your way, just like it's coming to Boise. So we need to put NIMBY on our radar screen and be keeping track of what NIMBY's doing. And in Southern California, while they're hurting California, they're really pushing stuff your way. It could follow. When I grew up in Colorado, it was a very conservative place and whatnot there. So the next thing I want to do is talk about ESG and think about the following, because I'm working with a client right now on this particular issue that's in your region. And the challenge we have with ESG working, everybody wants renewable, more wind farms, more solar farms. Problem is nobody can get a transmission line built. And so if we can't connect the electricity from solar and wind farms with transmission lines, it does no good. And so in the mountain region, particularly because of forest fire risks, and nobody wants to look at a power line, we're not able to do these. And so we can't get this green energy to where it's needed in markets like Denver. How do you take it from wind and solar farms in the plains and out near Kansas and get it into, say, the Denver marketplace? So this is a big issue. We're going to have to figure out on the ESG. We're also going to have to figure out about the charging stations and how do we get enough EV charging stations. Right now, we have about 45,000, but we have 275 million cars on the road, and we're going to be building 2 million EVs a year next year, and we only have 45,000 places that can recharge EVs. The numbers just don't add up to see the EV growth if we don't get a charging infrastructure growth here. The other one is ESG scoring. I mentioned this early on, that we have now got down to the property level, where every building is getting an ESG score. If your score is bad or it's in a portfolio, it can't transact, or it's going to be more impactful than a cap rate. The only entity out there that's doing it right is IREM. They're an affiliate of NAR, a good relationship with us in the CCIM Institute. Look at what IREM has done on ESG scoring. It's now been approved that you can use an IREM ESG score on a property or portfolio level versus the ones by ISS and Glass Lewis. And that could have a huge impact on the property value. It can affect it by 10 to 20%, or the difference between being able to get a loan or get an investor and not get one. So really be paying attention to this ESG scoring and the ESG investing. We're now pulling the Band-Aid off, and we're realizing the infection's still there, that the returns aren't there. And so while 2, 3, 4, 5% of capital in many institutional funds and banks are being said go into ESG, and an ESG investment, you've got to figure out how you can get your property or your client's property qualified as an ESG asset, just like the LEED certification is going to become as important, because you can get more affordable capital. More capital will come and be allocated to you, but the returns are terrible. They're just showing that this has been kind of a smoke and mirrors thing. So we really got to pay attention to, it starts with the idea of ESG and DEI, and it moves into scoring, and then it moves into how capital flows. And if it's all screwed up and you don't understand who's got it right, who's got it wrong, you can't help your client or your own portfolio or their assets. This is a good example in Utah. This is their new electric power systems that's going to expand at their Logan headquarters. And kind of some of the things that they're trying to do, and the economic impact. This is the kind of good stuff. This is what spills over, and anybody that benefits from this. So tip of the hat here. This is good ESG investing in Utah. So I just thought I'd pull a good example out here for you. There's another one I want to try to pretty much wrap up here on. It's called PACE, and this is the Property Assessed Clean Energy Program. And about 35 of our 50 states in the country have legislatively approved a PACE program. And what it essentially allows you to do is to add to your property assessment the cost to amortize converting a building to clean energy. So you can upgrade the HVAC, you can put in new windows, you can do whatever you need. And because it goes in on the property assessment, guess what? It's senior to the bank debt. You don't have to talk to the lender. And so the entity in the state that has this the most together, most involved, is Texas. Charlene Haydinger, who I've met, and I did a crew conference in San Antonio earlier this year with, is the expert. You guys have a program that's approved in Colorado for this. It is the neatest way that you can advise a client on how to upgrade an older or smaller building and make it energy efficient, make it ESG compliant, and basically have no impact or disturbance on your loan. It doesn't have to be prepaid. It's transferable later on. And the only way the PACE program approves it is there has to be a net benefit in the NOI. The NOI can't go down. Basically, the expense savings have to count up to basically cover it. But it's a really, really good program. If you haven't studied it, here's some links. I can go into it more. We might write a paper on it. So with that and all that wonderful news that I gave you about water, inflation, and ESG, I'll give you one last thing to think about, to not worry about. Go into the mountains this weekend. You got Labor Day coming up. Look at the sky. I was over in the San Luis Valley and dealing with family that were in late stages of life. There's no town for like 100 miles. And I could see meteor showers and stars that look better than the planetarium. We don't get that here in the Southeast with all of our humidity and our cloud cover and whatnot. Here's the real story. We might find out we don't need to worry about any of this because it's going to all be Neptune's problem. There's a star rotating around Neptune that threatens to shift its orbit. And if that happens, the entire solar system collapses or collides. So Neptune here and its star could crash the whole world and the whole planetary system here in the next year. So what we're worrying about may be futile. It's going to be Neptune's fault. So with that, this is again always a little bit about our company and my partner Beverly Keith, who I'm very appreciative to, and what we do. And with that, I'll throw it back. I'll stop sharing and we'll throw it back to you, Doug, to see if you have any questions or any time left.
It looks like we have time for one question. I'm just pulling one off here. This one I really like. It says, does any of your charts answer whether or not Park City or Vail Resorts is going to have better snow this year?
I think absolutely so. If you look at the La Nina cycles, it's one that is going to bring more monsoonal, like you've been getting the rain. I was over the San Luis Valley and Vail over the 4th of July, and I grew up there. I've never seen it so wet over there. They wouldn't do fireworks. We had to do a drone fireworks show, and it was terrible. They didn't know how to do it. But you're seeing the monsoonal flows. I think those are going to continue. The weather patterns from Colorado State University say maybe the hurricanes aren't going to be as bad, and lots more water. Look what's happening right now in Arizona and Nevada. We might even fill up Lake Powell a little bit. We might get it to where maybe not so many bodies float to the surface. My forecast, Utah and Colorado are going to have a good snow season if this monsoonal flow stays. So I think it's going to be pretty good. Enjoy snow skiing and snowboarding. How's that for being optimistic?
There you go. That's the way to end it. I apologize for the questions I didn't get to. I know we're needing to wrap up here. We've got 1 minute. Casey, I wanted to say thank you again for sharing your expertise with us today on this webinar. And thanks everybody for joining or attending. As a reminder, the recording will accompany the presentation. You will be emailed if you are a registered attendee. And if you're not already a CCIM member or a part of the Institute, please go ahead and sign up for the newsletter at ccim.com. There are other things to stay tuned for, and it's good to be in the loop for it. So again, thanks, Casey, and we appreciate everybody who's involved.
Thank you all. Have a good weekend and good Labor Day coming up. Go watch Neptune.
Thanks, Casey. Appreciate it.
Take care.